Okay, so I'm in Las Vegas for the NACLB conference, the National Alliance of Commercial Loan Brokers. So we get to meet brokers, lenders, learn about the industry, etc. Great event to be at, and I figured it was a good opportunity to talk to a lender that I work with. So this is David Deems from Visio Lending, who's a DSCR lender that we work with our own brokerage, and also my students that I coach. I bring them to David as well. So I figured it was a good opportunity to talk to David and just get a little bit of insight into his life as a lender and what he hears from people. Because obviously I talk all the time, the content I shoot about life as a broker and what we deal with. So good to get some insight from the lender standpoint. So David, just tell me a little bit about yourself and Visio and what you guys do.
Well, Visio is the DSCR lender, the original outfit that created the debt service coverage ratio loan program. We basically qualify the loan, as you know, based on the rent covering the PITIA. So for me, the most questions I tend to get have to do with where we're getting the rent numbers from, or is the property leased? For instance.
So let's talk about that then. Okay, so what are the three most common questions that you get from brokers? Not from borrowers, but from brokers.
So brokers, the three most common questions tend to be, how do you arrive at market rent? Where are you getting the market rent number? Because when we are qualifying a loan based on the market rent, or based on the rent, we need to know what that number is. We'll order an appraisal, order the market rent analysis with that, and the appraiser is using the information that's available to them to calculate the market rent. It's a common misconception that some people tend to think that appraisers are going to go out and knock on doors to find out what private landlords are charging for their tenants. That doesn't happen. So the data needs to exist in order for us to get the number that we need.
So they're using recent comps.
So they're using recent comps, correct. And sometimes when we get the market rent analysis in, it may be a different number than what we were expecting. Now, if that number is lower than what we were expecting, it is now jeopardizing our debt service coverage ratio. We just, at Visio, only need to be over 1. So as long as the rent is covering the mortgage payment, because taxes and insurance and association dues are included in that.
And for you guys, for Visio, even if the actual rent, if the property is leased, even if the actual rent is higher than the market rent, you're still using the market rent?
Correct. The final DSCR calculation is based on either actual rent or market rent, whichever is the lower of the two.
Right, but that's a Visio way, so not every lender does it that way. And
Correct.
That's kind of important, and I talk about this quite a lot. The great thing about DSCR loans is all lenders do things different. So that's the way you guys do it. That
Right.
might not necessarily be the way a different lender does it.
Correct. Some people like Rocky Road, some people like Mint Chip.
There you go. Perfect analogy.
We're vanilla with sprinkles and caramel sauce, chocolate sauce. You can kind of build your own sundae with us. We have true common sense underwriting, so we're gonna be a little bit more accepting of less stringent in some ways. So you're right though. Everybody has their own flavor preference. What works for them, right?
Okay, so question number 2 then. What's the next most common?
How is rent calculated on short-term rentals?
Okay.
Visio is actually, because we're the original creator of the DSCR loan program, about 7 or 8 years ago, we decided to thoroughly underwrite short-term rental properties, and they developed a very intimate relationship, a very close relationship with AirDNA. That is a website that pulls comps of other short-term rentals that are listed on VRBO and Airbnb in that area.
And anyone can use that site, because I use it too to run comps.
Absolutely.
Yeah.
We have probably a different account than what you have, so we see a little bit deeper into that, but ultimately, most of the time as you've probably experienced, when you go on AirDNA, most of the time it'll pull up accurate information, but sometimes it'll pull up 2-bedroom, 2-bath for a 4-bedroom, 3-bath property.
But you can change those parameters.
Correct. You can modify that, but that in turn adjusts the comps that it's now using, right?
And so AirDNA factors in occupancy rates in that market, etc. So AirDNA is a really good tool to estimate rents for an Airbnb property. So, I mean, investors use them too. I have clients that use
Yes.
AirDNA because it helps them make a decision on whether this is a property they want to buy or not by projecting the STR revenues. So then, okay, so you use those AirDNA figures to calculate the DSCR for a short-term rental property.
We take a 20% haircut to mitigate the risk. Because if the property has no history of being operated as a short-term rental, we're going to mitigate the risk there by taking that number, taking a haircut, and that will be what we use for the final DSCR.
Okay. Yeah, and again, every lender does this different. So Visio do it this way, they can use AirDNA. Some lenders will not use AirDNA at all. They'll use long-term market rent, actually, even if the property is being used as short-term. Okay, so then number 3, what's the third most common question?
Before we move on,
Oh,
I've
yeah,
actually recently learned that there are some lenders out there that are starting to use AirDNA, but there's a new version of AirDNA that gives a market score, and some lenders, if it doesn't have a high enough market score,
Interesting.
we do not.
Interesting.
So,
Okay. Wow. Okay. Good to know. Okay, number 3, what's the third most common question?
Third most common question, what do I do if the property is not leased? And
So what do you do?
I say, send it my direction. I love it when the property is not leased because, like I have stated before, our final DSCR calculation will be based on actual rent or market rent, whichever is the lower of the two. If a property is not leased, then there is no actual rent. There is no tenant that has been receiving a pandemic discount and is paying hundreds of dollars below market rent, or the investor that is selling the property and we are now financing the purchase. The reason why they're getting off the property is because they've allowed that tenant to continue to pay well below market rent. So of course they're not cash flowing as much.
Yeah. Okay, so obviously for vacant properties, we're talking usually about cash out refinances, because obviously most of the time if someone's buying a property to put a tenant in there, it's probably vacant. That's okay. Every lender is cool with that on a purchase, obviously. But for refinances, which obviously a lot of BRRRR investors do, especially with a cash out refinance, they want to get their cash out right after they finish the rehab. The property's not leased yet. You guys are a great avenue for vacancy properties.
Correct.
Properties with vacancy, again, different other lenders. Some other lenders require a lease,
Right.
require the property to be tenanted.
Right.
So, okay, so you can handle that well.
Yes, we don't require that's oftentimes too, when investors feel as though they have to stabilize the property, have to get the tenant in there before they can start the process. We don't have that requirement.
Yeah.
Let's get the ball rolling. Let's get them the cash that they need so that they can go and continue the process.
Cool. All right, well, thanks, David. Appreciate your time. Thanks for doing this.
Of course.
Visio Lending, David Deems, great guy, great AE, great company to work with. They're a big lender of ours. And yeah, great to get some insight from a lender standpoint. Appreciate it.
Appreciate the opportunity.